US dollar collapse imminent, why silver is your only life raft. We are currently standing on the precipice of a financial event so significant that it will likely divide history into two distinct eras: the age of paper promises and the age of tangible reality. If you are looking at the ticker tape today and seeing silver hovering around the $50 mark, and you feel a sense of vertigo, I need you to suppress that emotion immediately and look deeper at the structural rot underneath. The price action we are witnessing right now is not a bubble, and it is certainly not a speculative frenzy driven by retail investors chasing a trend. Rather, it is the sound of a pressure cooker that has been simmering for decades finally blowing its lid. The mainstream financial press will try to tell you that this is a temporary supply chain hiccup or a result of transient inflation. But those of us who have spent 20 years studying the plumbing of the global monetary system know the truth. We are witnessing the systematic failure of the fiat currency experiment, and the price of silver is simply the smoke detector going off in a burning house that the Federal Reserve locked us inside of years ago. To understand why we are seeing these violent price movements, you have to zoom out and look at the macroeconomic nightmare that Washington and Wall Street have constructed. We have a national debt that has spiraled so far out of control that it is mathematically impossible to repay in real terms, meaning the only option left for the central planners is to inflate the currency until the debt becomes meaningless. They are choosing to sacrifice the purchasing power of the American saver to save the balance sheets of the banking cartel, and this is a story as old as Rome itself. When you print money into oblivion, you destroy the trust that binds a society to its currency, and when that trust evaporates, capital flees into assets that cannot be printed, debased, or canceled by a bureaucrat with a keystroke. Silver is not rising in value. The dollar is collapsing in real time against the only objective measuring stick that has survived for 5,000 years of human history. The specific catalyst we are watching unfold right now involves a massive dislocation between the paper markets in London and New York, and the physical markets in Shanghai and the industrial world. For decades, the price of silver has been determined not by the physical exchange of metal, but by the trading of paper contracts that claim to represent metal, contracts that are leveraged 100 to 1. This system works beautifully for the bullion banks as long as nobody asks for the actual silver, but the moment confidence shakes and industrial users demand delivery, the entire charade begins to crumble. We are approaching a critical date, December 31st, which acts as a deadline for the London Bullion Market Association to reconcile its books. And for the first time in my career, I am seeing genuine fear in the eyes of the establishment because the physical metal simply is not there to back the paper obligations. Let us speak frankly about the supply dynamics, because the input data we are seeing from the mining sector is nothing short of catastrophic for the short sellers. We have a situation where Mexico, the world's premier silver producer, is effectively closing its doors to exports, tightening its grip on its natural resources in a move that screams of resource nationalism. When you combine this with the fact that silver ore grades are plummeting globally and no major new mines are coming online, you have a recipe for a supply crunch that no amount of financial engineering can fix. You cannot print silver, you cannot digitize it, and you cannot conjure it out of thin air. It must be dug out of the ground by immense capital investment and labor, neither of which can react quickly enough to meet the explosion in demand we are seeing from the green energy sector and monetary investors alike. The industrial demand story is the second pincer in this squeeze, and it is the one that the Wall Street analysts consistently underestimate because they do not understand physics. Silver is not just a monetary metal. It is the most conductive element known to man, making it absolutely essential for the solar panels, electric vehicles, and high-tech electronics that the entire global economy is pivoting toward. We are seeing a scenario where the industrial users, companies like Tesla, Samsung, and Apple, are bypassing the COMEX entirely and going straight to the refineries to secure supply because they know that if they don't have the physical metal, their assembly lines stop. This is draining the global stockpiles at a rate of hundreds of tons per month, specifically in the Asian markets, leaving the Western vaults in London and New York running on fumes just as the financial investors are starting to wake up to the opportunity. There is a psychological component to this market shift that we must address, which is the concept of swimming naked that Warren Buffett famously alluded to. For years, the bullion banks and the central planners have been swimming naked, leveraged to the hilt, shorting paper silver to suppress the price and maintain the illusion of a strong dollar, relying on the high tide of liquidity to hide their exposure. But now, due to rising interest rates and the physical drain from the East, the tide is going out faster than they ever anticipated, and we are about to see exactly who has the metal and who has nothing but empty promises. This December 31st deadline is not just a calendar date. It is a moment of truth where the accounting tricks used to suppress the price of silver will collide with the undeniable reality of physical scarcity. We are seeing a massive migration of physical metal from west to east, a geopolitical shift that signals the end of Anglo-American dominance in the precious metals pricing mechanism. The Shanghai Gold Exchange is seeing withdrawals running at 40 to 50 tons a week, a blistering pace that suggests China is systematically draining the liquidity from the Western system to back its own currency or industrial base. This is strategic warfare played out on the balance sheets of sovereign nations. While the US government distracts you with political theater, the BRICS nations are quietly accumulating the hard assets necessary to launch a new financial system that does not rely on the US dollar or the SWIFT payment network. They know that in a world of fracturing alliances and weaponized sanctions, the only asset that has no counterparty risk is physical gold and silver held within your own borders. The concept of backwardation is something that the average retail investor ignores, but to a commodities analyst, it is the flashing red light on the dashboard that indicates imminent engine failure. Backwardation occurs when the spot price of physical silver is higher than the futures price, a phenomenon that should never happen in a healthy market, because it implies that the market is willing to pay a premium to have the metal now rather than wait for delivery later. We are seeing lease rates spike and backwardation persist, which proves that there is a desperate shortage of available bars in the wholesale market. This is the market screaming that the paper price is a lie, and that the real price of physical silver is significantly higher than what is flashing on your computer screen. When we talk about the difference between gold and silver, we have to acknowledge the hard money hierarchy. Gold is the money of kings, but silver is the money of gentlemen and the indispensable fuel of modern industry. While Warren Buffett may dismiss gold as a rock that simply looks at you, even he cannot deny the utility of silver, which he has purchased in massive quantities in the past because he understands value investing. The ratio between gold and silver coming out of the ground is roughly 7-to-1, yet the price ratio has been manipulated to sit at 80-to-1 or higher for years. This is a geological impossibility that cannot be sustained forever, and when the reversion to the mean occurs, silver will outperform gold by a magnitude that will shock the financial world. The manipulation of the silver market is not a conspiracy theory. It is a matter of public record, evidenced by the billions of dollars in fines paid by major banks for spoofing and rigging the precious metals desks. For decades, these institutions have used their immense capital to paint the charts, slamming the price down during quiet trading hours to trigger stop losses and demoralize the retail holder. However, this game only works when you have an infinite supply of paper to throw at the market. It stops working the moment the physical market disconnects from the paper price. We are seeing that disconnect now, where the premiums on physical coins and bars are decoupling from the spot price, creating a two-tier market where the paper price is irrelevant to anyone who actually wants to hold the metal. Let's discuss the implications of the December 31st final checkout, mentioned in the intelligence we have received regarding the LBMA and COMEX vaults. This year-end audit forces the custodians to prove that the metal allocated to clients actually exists, stripping away the layers of rehypothecation where the same ounce of silver is leased out to 5 different people. If the numbers do not add up, we could see a failure to deliver event, which is the nuclear scenario for a commodities exchange. A default on the COMEX would force a force majeure, where contract holders are settled in cash rather than metal, effectively admitting that the exchange has no silver and destroying faith in the paper pricing mechanism overnight. The behavior of the silver price recently, oscillating violently between the mid-40s and the mid-50s, is a classic sign of a market in terminal distress trying to find its true equilibrium. This volatility is designed to shake you out, to tug on your heartstrings and make you doubt your conviction, because the smart money needs your silver to cover their short positions. They want you to look at a $4 drop and panic, selling your physical insurance back to them at a discount, so they can survive another day. You must understand that this volatility is noise. The signal is the undeniable trend of currency debasement and supply destruction. If you are selling your silver because of a daily dip, you are handing your life raft to the captain of the Titanic just as the iceberg comes into view. We must also consider the broader context of financial sovereignty and why owning physical metal is an act of rebellion against a corrupt system. When you hold silver in a private safe, you are your own central bank. You have no counterparty risk, no exposure to bank failures, and no reliance on the internet or the power grid to access your wealth. In an era of digital surveillance, central bank digital currencies, and potential capital controls, silver represents one of the last bastions of financial privacy and freedom. The establishment hates gold and silver not because they are barbarous relics, but because they are the only assets that the establishment cannot control, inflate, or track with total precision. The narrative that silver is wealth, rather than an investment, is a crucial distinction that needs to be drilled into the psyche of every American saver. An investment is something you buy with the hope of selling it later for more fiat currency, effectively gambling on the fluctuating value of paper money. Wealth is something you accumulate to preserve your purchasing power and pass down to future generations, regardless of what the currency does. When you view silver as wealth, you stop caring about the dollar price and start caring about the number of ounces in your possession. You realize that the goal is not to trade your silver for more dollars, but to survive the inevitable death of the dollar with your purchasing power intact. The looming crisis is not just about silver. It is about the mathematical certainty that the US dollar will lose its status as the world reserve currency. The weaponization of the dollar through sanctions has accelerated the timeline for this collapse, forcing nations like Russia, China, and India to develop alternative payment systems backed by commodities. As the demand for dollars decreases globally, those dollars will flood back into the domestic US economy, triggering a hyperinflationary event that will make the inflation of the 1970s look like a walk in the park. In that environment, silver will not just be an investment. It will be a mechanism for survival, used to facilitate trade when the paper currency is no longer trusted by the merchant on Main Street. We are looking at a future where the paper markets will likely be suspended or rendered irrelevant, and the price of silver will be determined by direct negotiation between buyer and seller based on physical availability. This is what we call price discovery, and it is something we haven't seen in the precious metals markets for over 50 years. When the paper suppression scheme breaks, the price will not just double or triple. It will seek a level that balances the massive expansion of the money supply with the finite amount of above-ground silver. Some analysts predict triple-digit silver, but I would argue that in a currency crisis, the price becomes meaningless because you won't be selling your silver for dollars. You will be using it to acquire real assets like land, energy, and food. The new shiny you rhetoric we hear from the retail side of the market often trivializes the gravity of the situation, but the underlying sentiment of renewal is accurate in a financial sense. Clearing your balance sheet of toxic fiat assets and replacing them with tangible sound money is a form of financial purification. It aligns your personal economy with the laws of nature rather than the whims of central bankers. Just as silver was historically used to purify water and fight disease, holding silver in your portfolio purifies your wealth by removing the disease of debt and inflation that infects every dollar in circulation. Let's circle back to the limited time offer concept regarding the current price dips, because this is the most actionable advice for the contrarian investor. If you walked into a store and saw a high-quality suit or a pair of durable boots on sale for 40% off, you would not panic. You would buy 2 pairs. Yet in the financial markets, when the price of an asset drops, people instinctively run for the exits because they are driven by fear rather than logic. You must train your mind to see a drop in the silver price not as a loss of value, but as a temporary window of opportunity provided by the incompetence or manipulation of the market makers. These windows are closing, and the input data suggests that by the end of 2025, we may never see these price levels again. The role of the Silver Slayer and other independent commentators has been pivotal in waking up the public, but the institutional analysis backs up their enthusiasm with cold, hard data. We are seeing a divergence where the retail public is buying physical metal hand over fist, draining the retail supply chain, while the institutional paper shorters are doubling down on their bets. This is the classic setup for a short squeeze, similar to what happened with GameStop, but on a global scale and involving a strategic commodity rather than a failing video game retailer. When this squeeze triggers, the scramble for collateral will be unlike anything we have witnessed in financial history. The mention of December being a quiet assumption tested by reality is the perfect way to describe the complacency of the current market. Investors assume that the vaults are full, they assume that the dollar is strong, and they assume that the geopolitical order is stable. None of these assumptions are true. The vaults are being drained, the dollar is being debased, and the geopolitical order is fracturing. December 31st represents the moment when the quiet assumptions are shattered by the loud reality of a failed delivery, and those who are holding paper contracts will be left holding the bag, while those who hold the metal will be holding the power. We must also address the technological aspect of silver, specifically its use in the burgeoning AI and green energy revolutions. You cannot build a solar panel, an electric vehicle battery, or a high-end server for artificial intelligence without silver. It is the best conductor of electricity and heat, and there is no substitute that is cost-effective. As the world transitions away from fossil fuels and toward electrification, the demand for silver is becoming inelastic, meaning that industry will pay whatever price is necessary to secure the metal. This puts a floor under the price of silver that does not exist for gold or cryptocurrencies, making it a dual-threat asset, a monetary hedge and an industrial necessity. The luckiest stacker mindset is a bit too casual for the seriousness of capital preservation, but it touches on an important truth. Luck is what happens when preparation meets opportunity. The people who will be lucky in the coming years are the ones who had the foresight to convert their labor into silver when it was cheap and unloved. They are the ones who recognized that the fiat system is a Ponzi scheme running out of new investors. We are not gambling on a stock going up. We are betting on the laws of mathematics asserting themselves against the laws of politics. Mathematics always wins in the end. The comparison to cryptocurrency is inevitable in these discussions, but it is a comparison that often misses the point of tangibility. While I am not anti-crypto, I am a realist who understands that if the power grid goes down or the government decides to ban the on-ramps and off-ramps, your digital wealth is inaccessible. Silver does not require a password, an internet connection, or a third-party validator to exist. It is wealth that you can hold in your hand, hide in your floorboards, or transport in your pocket. In a scenario of extreme crisis or cyber warfare, the tangibility of silver is its greatest attribute, providing a level of security that no digital asset can match. Let's analyze the tide going out metaphor one more time in the context of the LBMA's internal structure. The LBMA relies on a fractional reserve system, much like a commercial bank, where they hold a fraction of the metal they claim to owe to their depositors. This works fine when everyone is content leaving their gold and silver in the vault, but it fails catastrophically when confidence is lost. The massive withdrawals from the Shanghai Exchange are the equivalent of a run on the bank. They are calling the LBMA's bluff, demanding the physical metal and removing it from the Western liquidity pool. This exposes the naked shorts who have been selling silver they don't own, and soon the entire world will see their nakedness. The specific price targets mentioned in the data, 50, 54, 46, are merely noise within a much larger uptrend. If you are obsessing over whether you bought at 48 or 52, you are missing the forest for the trees. The real question is whether you possess any metal at all when the price goes no offer. No offer means that you call your dealer, and they simply tell you they have no silver to sell at any price. That is the moment when the paper price becomes zero, and the physical price becomes infinite relative to the currency. We are moving toward a no-offer market in silver faster than anyone realizes. The warning about silver miners is also astute. While mining stocks offer leverage, they also carry execution risk, jurisdiction risk, and management risk. A mine can be nationalized, taxed into oblivion, or shut down by a strike. Physical metal has none of these risks. It is the ultimate form of equity with no liability. If you are looking for life-changing wealth, the miners can provide it. But if you are looking for life-saving insurance, you must hold the metal itself. The hard money philosophy dictates that you first secure your foundation with physical assets before you speculate on the companies digging them out of the ground. We are approaching a period of history where the return of the real will decimate the reign of the virtual. For 40 years, financialization has dominated the economy, rewarding those who move paper and punishing those who produce real goods. That trend is reversing. The producers of commodities, oil, food, metals, are regaining pricing power from the consumers of commodities. Silver is at the nexus of this shift. It is a tangible asset that has been suppressed by financialization, and as financialization fails, silver will be released like a beach ball held underwater. The force of its ascent will be equal to the force that was used to hold it down. The December 31st narrative serves as a potent psychological anchor for the investor class, forcing them to confront the reality of their portfolio allocations before the calendar turns. It is a moment of accounting, both literal and spiritual. Have you protected your family? Have you diversified out of the dollar? Have you secured assets that will survive the coming storm? If the answer is no, then December 31st is not just a date. It is a deadline for your financial survival. The system is fragile, opaque, and deeply corrupt, and counting on it to protect your wealth is the definition of insanity. When we look at the advice to buy every dip, it is not just a slogan. It is a strategy for dollar cost averaging into a position of strength. By buying consistently, regardless of the daily price action, you smooth out your entry point and accumulate ounces over time. This removes the emotion from investing and turns it into a discipline. The goal is to accumulate as much weight as possible before the reset occurs. Whether that reset happens on December 31st or later, the mathematics guarantee it will happen. The debt cannot be paid, the currency cannot be saved, and the only exit is a revaluation of gold and silver to cover the liabilities. We must also consider the hidden vulnerability of the global banking system. The banks are sitting on trillions of dollars of unrealized losses in government bonds and commercial real estate. Their balance sheets are impaired and they are technically insolvent. In this environment, silver is the anti-bank asset. It is the asset that thrives when banks fail. By holding silver, you are effectively shorting the banking system. You are betting that the banks have mismanaged the economy and that the reckoning is inevitable. Given the track record of the Federal Reserve and the commercial banks, that is the safest bet you can possibly make. The time machine concept is a powerful visualization tool. Imagine yourself 5 years from now looking back at today. The dollar has lost half its value, inflation is rampant, and silver is trading at triple digits. Would you care that you paid $50 an ounce? No. You would be begging for the chance to buy more at that price. We are living in the good old days of cheap silver right now, and most people are too distracted to see it. Do not be the person who looks back with regret. Be the person who looks back with relief because you took action when the signs were clear. The disconnect between the paper price and the physical reality is the greatest arbitrage opportunity of our lifetime. You can currently buy a scarce, strategic monetary metal for a price that is far below its production cost in real terms. This anomaly exists only because of the manipulation and the ignorance of the masses. Once the masses wake up or the manipulation breaks, the window will slam shut. You are competing with central banks, industrial giants, and sovereign wealth funds for a piece of a very small pie. Do not wait until the evening news tells you to buy silver, because by then there will be none left to buy. Warren Buffett's reluctance to touch gold, while having a history with silver, tells you everything you need to know about utility. He understands that gold is a currency, and he bets on productive businesses. But silver is a productive asset. It works for a living. It purifies water, it conducts energy, it heals wounds. It is the hardest working metal in the periodic table. This gives it a value floor based on utility that gold lacks. When the monetary demand for silver kicks in alongside the industrial demand, the price will go parabolic because the supply cannot respond. It is the perfect storm for a commodities bull market. The Silver Slayer persona in the input text represents the voice of the frustrated common man who sees the rigging of the game. This sentiment is spreading across America. People are tired of working harder for money that buys less. They are tired of the elites playing by a different set of rules. Silver stacking is a grassroots movement of people opting out of that corrupt system. It is a vote of no confidence in the Federal Reserve. It is a way to reclaim your labor and your time from the thieves of inflation. This movement is growing, and as it grows, it puts more pressure on the physical supply, accelerating the inevitable breakout. We are watching the final days of the paper silver market. The lease rates, the backwardation, the vault drains. These are the death throes of a manipulated system. The December 31st date is a marker, a line in the sand where the illusion meets reality. Whether the explosion happens that night or in the months following, the fuse has been lit. The trajectory is set. The dollar is dying, and silver is being reborn as the essential asset of the 21st century. The only question left is whether you will be a spectator or a participant in the greatest wealth transfer in history. In conclusion, the path forward is clear for those who have eyes to see. The noise of the daily price action is a distraction designed to separate you from your wealth. The signal is the physical scarcity and the monetary debasement. Do not be swayed by the volatility. Do not be discouraged by the manipulation. These are the signs that you are over the target. The establishment is throwing everything they have at the price to keep it contained because they know that once silver breaks free, the game is over. You must cultivate the mindset of a long-term holder. This is not a trade, it is an insurance policy for your financial future. Store your metal safely, tell no one where it is, and go about your life with the confidence that you are protected. When the crisis hits and the panic sets in, you will be the calm in the storm. You will have the resources to protect your family and your community. That is the true value of silver. It is not just about getting rich, it is about being resilient in a fragile world. Remember the lesson of the tide. When the liquidity dries up and the credit contracts, the naked swimmers will be exposed. The banks, the hedge funds, the naked shorters, they will be revealed as frauds. But you, the physical holder, you will be clothed in the armor of sound money. You will be standing on solid ground while they are washed away. That is the difference between gambling in their casino and owning the casino's chips. Take advantage of the dips between now and the end of the year. Treat every price drop as a gift. The window is closing. The supply is vanishing. The world is waking up. By the time the clock strikes midnight on December 31st, the landscape may have shifted irrevocably. Do not let that moment pass you by. Secure your position, hold the line, and trust in the fundamentals of history, geology, and mathematics. This is the battle of our generation, fiat versus sound money. Paper versus metal. Lies versus truth. The outcome is inevitable, but the timing is the variable. Position yourself now so that you don't have to panic later. Own the physical. Reject the digital illusions. And remember, in a world of universal deceit, holding gold and silver is a revolutionary act. Stay skeptical, stay prepared, and keep stacking.